All right, you're the moderator?
Yes.
All right, are you logging in?
I just need the sheet with the.
Yeah. So if you go in here, it will be in there. You don't even need that. So if you go into join a meeting, you'll find E1. That's right. There we go. Hi, Kenzie.
Hi, how are you?
Good. If you could just kind of drag that over too, just. Yeah, or yeah, that works. Did you guys get a chance to read topic focus 3? Did you? Good. Is it making sense? Does it make more sense after you've read it? It's just a few pages, except that, I mean, it's just, I think I can just picture the theory kinds of stuff behind this rather than the numbers. I think I had too much coffee today. I feel like I did a nice long run too. I still feel like. So if I'm going too fast, give me the slow down. And it's my birthday, so I'm excited.
Happy birthday.
Thank you.
Happy birthday.
Thank you. Happy to be sharing it with you today. All right, well, 32, time to start. Okay, so we are going to continue with that problem we were working on last class. But before we get right into that, let's just kind of do a little review about what we're talking about here. And that way I'll give you a chance to kind of ask questions or just kind of bring that back, all of that nice stuff back into your head again. So we're talking about variable costing. Variable costing is a new management tool, right? It is run in addition to your accounting system. Everybody has to have the accounting system. That's GAAP, that gives you your financial statements. This is a management system that is going to do two things for you. It's going to give you your contribution formatted income statement, which you know is very useful for you as a manager. And then on top of that, what it does is it takes out your inventory distortion. So what I showed you the other day is that your accounting system sometimes is hard to read, right? You're making improvements, you're trying to increase the sales volume of your company. And when you look at your net income, there are two things affecting that net income. Yes, all of your efforts, if you're increasing the volume, will cause your net income to go up, but also your inventory levels that are fluctuating are making changes in your net income as well. So it gets really hard to see how well you're performing in relation to the changes you are trying to make. And so variable costing takes out that inventory distortion. When you look at your net income, the only thing that's affecting that net income is going to be the revenue or the sales that you are bringing in. Much easier to read in terms of making improvements in your company. All right, so remember, we went through that income statement 3 times on Monday. We said, first of all, what happens when there is no inventory fluctuation? If we are producing and selling the exact same amount, then we saw that there was no difference in net income. If there's no inventory fluctuation, then there's nothing that is going to change the net income between the two systems, right? There's no distortion to take out. But we saw when we produce more than what we sell, that's when you're going to have net income higher under your accounting system. That's when your net income is overstated. Because what's happening is in your accounting system, fixed factory overhead is part of inventory. And we know product costs go to the balance sheet and there they sit until that unit is sold. And that's when it goes to the income statement. So I showed you the other day, when you are producing more than what you're selling, you have some of that fixed factory overhead that is getting tied to inventory. And if it's not sold, then it has to stay on the balance sheet. So in this situation, when you are producing more than what you're selling, what's going to happen is you are deferring some of your fixed factory overhead. Did you pay the rent? Yes, you did. Do you have to show it as an expense? No, you don't, because you didn't sell the units that it was tied to. And so it's just waiting to go to the income statement, right? So it is, like I said, it gets confusing when you're looking at that net income because really it's overstated, right? Because you're just not expensing all of the costs that you actually incurred. And it's not that they go away, it's just a timing difference. As soon as you sell those units that fixed overhead is tied to, that's when you're going to see it released. And then we saw that with the last time we did the income statement, because when you sell more than what you produce, that means that you are selling or then releasing costs from a prior period. As soon as you are selling more than what you produced, that means you are selling something from another period. Anything that got deferred from another period, we said, nope, there was no revenue there. We couldn't match it to it. We left it on the balance sheet. But as soon as you sell it, that's when you're going to see the costs getting released. So in that last situation, you're going to have a lower net income, understated under your accounting system, because now you have all the rent from this period plus rent from another period, right? So in this case here, you are looking at your net income being understated, or it's going to be lower than your variable costing system. The only difference between the two systems is that fixed factory overhead is no longer a product cost, right? So why did we pull it out of product costs? because of the matching principle. I showed you that the matching principle, right, cost of goods sold is matched to revenue. You're saying this is what I spent in order to get that revenue. And that makes perfectly good sense when you're talking about your variable costs, because you know the variable costs are happening every time you produce and sell a unit. It doesn't make sense with those fixed costs, that fixed factory overhead, because that's not the way fixed costs work. We don't pay $1.50 in rent every time we make a unit. The rent is the rent. The way you get that fixed cost per unit is that you are spreading it out over all of the units that you produce. It doesn't mean that you're paying $1.50 every time you make a unit. It just means the fixed cost in total is constant. So that variable costing system is taking that out. It removes that timing difference. Okay. Any questions before we go back to that problem we were doing? All right, so let's take a look at the data again, and we'll go through this again. We had already done the income statement for year one, but let's do it again. So here we have a company that sells a product for selling price 68. And then I give you all of the information here. Direct material cost per unit 30. Direct labor costs per unit is 11. $5 for variable overhead. Variable operating expenses are $3 per unit. And then fixed factory overhead is given to you in total for $176,000. Okay. And then here's your fixed operating expenses. So during the first year of operations, the company manufactures 22,000 units and anticipates selling 16. So what we did here for this problem, and what I asked you to do, is calculate the income statement under absorption costing, right? So we calculate what the net income is going to be, and then before you prepare the variable costing income statement, I want you to be able to tell me what the net income is going to be. And then after you think you know what it's going to be, then prepare the income statement to go back and reconcile. Make sure that what you said was going to happen does happen. And if you can do that, then you know you've done your income statement correctly. Okay. All right. So if I'm making 22,000 units and I'm selling only 16, then my net income is going to be higher under which statement? Krill.
It's going to be higher under absorption costing.
Exactly. If I'm making 22 and selling 16, that means I'm going to have 6,000 units that weren't sold. And I know I'm taking this $176,000 in fixed overhead and I'm spreading it out over all of the units I produced, because in my accounting system, I'm valuing my inventory at the cost of making or producing it. So I'm looking at all the units I made and I'm spreading that fixed cost out over all of the units that I produced. So some of this $176,000 is going to be in the 16,000 units that were sold and heading over to the income statement. But the portion that is tied to those 6,000 units that weren't sold, we call that deferring, right? We're going to have some of this fixed factory overhead in those units that are not sold and will remain on the balance sheet in inventory. All right, step number one, you need to be able to figure out what it's costing you to make your unit, to make your inventory, right? So I gave you direct material, direct labor, and variable overhead. So under your variable costing system, remember, fixed factory overhead is no longer a product cost. It is not tied to inventory anymore, where it is a period cost and it will all get expensed in the period as incurred. You pay the rent, it is going to show up in that period. But here, under your accounting system, you know that anything in your factory is being incurred to make inventory, which includes the rent of your factory or your straight line depreciation. I need to include that in the value of my inventory. So I know that in my accounting system, my inventory is valued with an extra $8 of fixed factory overhead or $54. But in this new management system, I only have my variable production costs. Okay. Everybody's good? So I asked you to prepare an income statement under absorption costing, which means traditional format. Absorption is GAAP, and that's what we just learned. And so you know it is in the traditional format of sales minus cost of goods sold. Right, so in terms of calculating sales, I gave you the selling price of $68. And I also told you that we're selling 16,000 units, right? So I know my sales, I'm going to be earning revenue of $1,088,000. I also know under my traditional income statement, the first thing I'm going to deduct is my cost of goods sold, right? This income statement sets your expenses up by how they function. Inventory, not inventory. So here, cost of goods sold is where I'm matching the cost to the revenue. I sold that unit for 68, and I'm saying this is what it cost me to make that unit. So that's my cost of goods sold, subtract that out, and that's my gross margin or gross profit. And then I need to subtract out all of my period costs, right? All of those selling, administrative, operating expenses, they are always period costs. Whether you are variable costing or absorption costing, period is always period. It's just that fixed factory overhead will also be period as well. So you know, under your traditional income statement, anything that's not inventory is expensed after gross margin or gross profit. So you can see I've calculated the variable selling as well as the fixed selling. Selling expenses, cost of goods sold, sales are all using units sold, right? This is the income statement looking at what you're selling. When you're trying to do your inventory, figuring out what it costs you to make it, that's when you need units produced. Okay. Is everybody good with this? All right, so then after I have, I don't want to go on, and is everybody good with all of these numbers?
Professor?
Yeah.
Yes, so I was wondering, under the income statement, we only take the units sold, and under the balance sheet, we also take the units produced, right?
So in the balance sheet, we're looking at how many units we didn't sell, whatever's sitting in that, whatever we have that is still remaining in our inventory. So what I was just saying is, let me go back here. When I am trying to figure out the overhead that's getting tied to each unit, I'm going to take the overhead and divide by units produced. Because what I'm saying is, this is what it costs me to make my inventory. GAAP is telling you inventory is valued at the cost of making it, right? And if I made 22, I need to spread that rent out over the 22 that I made. But when you're doing your income statement, now I'm looking at what I'm selling, right? So your sales, and then you know the cost of goods sold is matching the cost of making the same units that you just sold. And then your selling expenses are also going to be incurred because you're selling that unit. So when you're looking at creating the income statement, it's based on units sold. Sophia.
I just had a question about where one of the numbers came from, but it was just from the other slide.
Oh, okay. Yep. Yes. As I was saying earlier, I had a lot of coffee, so slow. So if you want to go back and look at slides, you should probably always have your slides in front of you anyway, right? But if you, if you're not sure about a number, absolutely let me know. All right, so we know our net income under absorption costing. And so now this problem said, before you do the income statement, what will your net income be under variable costing? Right, so I gave you a couple of ways to think about this, right? Your book gave you a shortcut way of saying, what's the fixed factory overhead? Look at the change in your inventory, multiply that by the change in your inventory, and that will be the difference in your net income. Right, so if I'm going to do it that way, what I'm going to say is that fixed factory overhead we said was $8 per unit, right? We took our $176,000 and we spread it out over 22,000 units produced, and each one has an extra $8 of fixed factory overhead tied to it. Right, then I'm going to look at my change in inventory. So when you're talking about the change in inventory, you're saying, what's the difference between beginning and ending, right? I started with nothing. I made 22 and sold 16. So I know my ending inventory is 6,000 units. So I went from 0 to 6,000 units. That was the change in my inventory beginning to end. So the cheat is telling you, look at the change in your inventory from 0 to 600. If your inventory is increasing, that's telling you you produced more than what you sold. If your inventory levels are going up, that means you are producing more than what you are selling. So you know that the difference in this net income means that your absorption costing is higher, right? You have deferred some fixed factory overhead here. You have 6,000 units where you have some of that rent tied to those units that aren't getting expensed in this period. Less expense means higher net income under your accounting system. So I have the difference. I'm going to subtract the 48 from the 90, and this is going to be my net income under variable costing. It should be $48,000 lower, because when I look at this way, I have $8 of fixed factory overhead tied to these 6,000 units that did not go to the income statement, right? If they're tied to units that weren't sold, they have to stay on the balance sheet. There's no revenue to match it to. So I am looking at those 6,000 units with an extra $8 of fixed factory overhead tied to them. So I've deferred 48,000 of that 176. Or you can think about it the way the chapter tells you. Look at the change in your inventory and multiply it by your fixed factory overhead. Just remember, when inventory is going up, you have produced more than what you sold. And so you know you're going to have a higher net income under absorption costing. Okay, is everybody good with this? So this is where we left off last class, but if you want me to review anything again, all right, so year 1 is the easier year, right? In year 2, this is where things get more confusing. So let me go back to the problem here. In year 2, we're going to make another 22,000 units, but now we're going to sell 24, right? So what I'm looking at now is selling more than what I'm producing. Now I know my net income is going to be lower under my accounting system, because not only am I going to be releasing all the costs tied to these units that I made this period, I must be selling something for another period, right? I made those other units from another period, and when I'm selling them, that's when you're going to see them released. Okay. Come on. Okay. Oh, that's my, so then you can see I did that income statement under variable costing. Before we go into year 2, I just want to make sure that you understand you're going to be responsible for knowing how to do the net income under both of these, right? So the harder questions are going to be, what's the difference in net income? Or here's the net income under one, what will the net income be under the other? But you should be able to prepare income statements under both, right? So just take a look at this. Still, everything is same sales, right? You're still selling the same 16,000 units. But remember, your contribution formatted income statement does not set your expenses up by how they function. It is no longer about product and period. It is about variable and fixed, how they will behave as you are making changes. So you are deducting out all of your variable costs. Cost of goods sold is always variable, because this 46 is just your variable production costs. Direct material, direct labor, and variable overhead are all variable, always. And then here's your variable selling, right? I don't care about product or period. It is all variable or deducted from sales to give you contribution margin. And then here's all of your fixed costs. And notice, not in cost of goods sold anymore. It is a period cost, and you are always going to see 100% of your fixed overhead expensed in the period as incurred. It's no longer tied to the inventory and matched to revenue being, or inventory being sold. Okay. And you can see it is $48,000 less. All right, so here's year 2. So I'm asking you to do the income statement again. It's the same thing, and you want to practice this, right? It's the same format, products period. The only difference here is that I'm selling, in this case, 24,000 units instead of 16. So I still have the same selling price. My cost of goods sold for each unit is still 54, because remember, I produced another 22. And that only works, this is only still going to be 24 if you're making or producing the same amount from one period to the next. Because fixed factory overhead, that $8, is not a constant number per unit. Fixed cost per unit is not constant. The fixed cost in total is constant. The $176,000 is your fixed cost. Since I made 22,000 units in both periods, I spread each year that same cost out over 22. And so I just happen to have the same fixed cost of $8 again in this period tied to that unit. Okay, so 24,000 units because I'm matching the cost of making to the same units that I just sold. Sales minus cost of goods sold is your gross margin or gross profit. Again, the fixed portion of your selling expenses is the same, not affected by the extra volume, but your variable costs, they've given to you at $3 per unit. And again, you're multiplying it by the units sold. So I have my net income of $178,000 here. And now I want to predict what my net income is going to be under variable costing. What I know is it's going to be higher, right? I also know when I did this income statement, I have fixed factory overhead that is getting released from another period, right? I'm selling 24,000 units. I only made 22. All of the rent that I had tied to those units are getting sold. They're in here, they're expense. But I also have units from another period that are getting released here as well. So when I'm looking at the difference, when your inventory levels go down, that means that you are selling more than what you have produced. And that means your net income is going to be higher under variable costing. So if you want to do the shortcut way, you know the fixed factory overhead is still 8 in this period. And now you're going to look at your change in inventory. How much did your inventory change? Sometimes it's helpful to kind of think about it this way, right? Those 6,000 units that you hadn't sold from year 1, that's what you would have started with in period 2. You made another 22 and you sold 24, which means now I'm going to have 4,000 units unsold. Beginning plus cost of goods manufactured minus cost of goods sold gives you 4,000 units not sold. If I want to know the change in inventory, I went from 6,000 to 4,000. My inventory went down by 2,000 units beginning to end. So I look at the change in inventory beginning to end, multiply it by the fixed factory overhead. The difference is $16,000. So I know that I'm going to add that to my net income, my absorption net income, because I know I have more expense in here. I mean, yes, I know I have more expense and lower net income. So I'm going to add that to the 178, 16 plus 178. And this is my projection for net income under variable costing. Caroline.
Why is it increasing if the difference is negative?
Because inventory levels are dropping.
Okay.
right? So if your inventory levels are dropping, that means that you've sold more than what you produced.
Yeah.
And like I said, I like to think about this. I like to show it as the T account because then you can actually, I think, visually see what's happening here. So, and I also like to think about this the way I have it written up here. $8 of that fixed overhead was deferred from year one, right? We had that $48,000, right? So that, so that all of the fixed overhead that was tied to these units, when they're sold, you're seeing it released. But again, I didn't sell everything here, right? So how much do I have left over? You are releasing and deferring in the same period, right? You're releasing the $8 tied to these 6,000 units, but then you're going to defer $8 tied to these units. So the reason why I don't like to just look at the change and multiply it by the $8 is because that only works when you make the same units every single period. This is only $8 for both periods if you produce the same units, 22 and 22, right? That fixed cost per unit is not a constant. I prefer to think about it as $8 tied to these units. Were they sold? If they're sold, then the $8 tied to these units are released. I look at these units, they're not sold. I know the $8 tied to these units are deferred. Because if they don't have the same units produced each period, I'd need to know, did I use LIFO or FIFO, right? If I have different overhead applied to these two units, I would need to know, of the 4,000, are they the 22 or are they part of the 6? Okay, does that make sense? So much silence here, right? I'm getting some nods. Okay, good.
I have a question.
Yep.
So like, for example, on the midterm, you're gonna tell us if it's LIFO or FIFO, or how we're gonna make sure we are getting like the right calculation.
You have different production in different periods. You would have to know whether it's LIFO or FIFO. It's probably FIFO. And actually, if I didn't tell you it was LIFO or FIFO, I would say go with FIFO.
All right, thanks.
Use LIFO. Okay, and then again, this is the income statement done out to show you that yes, it did work. That changed, right? The slides are not working. The difference in 16,000 and adding that to your net income of 178, there it goes, does get you to a net income of 194. And also, Kirill, at the end of these slides, I put in another example where I did change the production volume. So that's probably a good problem to kind of go through as well before you do the homework, because I know in the homework you also have problems where the production volumes are going to be fluctuating. So you may want to go through that before you hit that homework problem. All right, so here's another problem, another way of looking at something, right? So just kind of a different approach. So here I'm telling you the following table shows the inventory balances in units for years 1, 2, and 3. Total fixed manufacturing costs were $30,000 for each of the last 5 years. And the units in year 1 beginning inventory were based on a production of 500 units. Right? Why are they telling you that? Why are they telling you fixed factory overhead is $30,000? And they're specifically talking about your beginning inventory here. They're telling you the beginning inventory in year 1 is where you made 500 units. The reason why they're telling you that is they're telling you how much fixed factory overhead is tied to these units. So if I take my 30,000 and divide by 500 units, What I know is each one of these 100 units has $60 of fixed factory overhead tied to it. Okay. So in year one, I'm starting with 100 units. I'm going to produce 500 and I'm going to sell 600, and then I'll have nothing at the end of the period. So what I'm asking you to do here is tell me what the difference between absorption and variable costing operating income is going to be, and be sure to indicate which costing system has the higher, is higher or lower. It's like playing The Price is Right. So fun. All right, so first of all, let's look at year one. Do you think your net income is going to be higher, lower, or the same? See, it's like Price is Right. Have you ever seen Price is Right, or is that like a really old thing? Okay, so what do you think, Brianna?
I think it's gonna be the same.
Okay, and why do you think it's going to be the same?
Because you sold them not, maybe it's not the same because you didn't sell as much as you did.
Okay, so that's good. So think it through.
But it would be- When you sold more than you produced, so would it be variable?
Yes, yes. Okay, so yep, so I'm looking here and I'm saying I started with 100, produced 500, but then I sold 6. So you sold more than what you produced, which means in your accounting system, not only are you releasing all of the 30, right, this 30,000 would have been spread out again over 500 units. So here I would have all of that 30,000 in these 500. Here you can see I'm selling them all. So all 30,000 will be expense, but now you're getting the extra $60 from that prior period hitting the income statement as well. So in your accounting system, you're going to have more expense and a lower net income, or like Brianna said, higher net income under your variable costing. Okay. How much higher? Brooke,
Would it be 6,000?
6,000, right? What's happening is the $60, right? That's why they gave you this information about this beginning inventory. You have $60 extra tied to these 100 units. If you're selling them, that's when the $60 is getting released. $60 in each one of these 100 units is going to give you 6,000 extra fixed factory overhead dollars in your accounting system. Right, so here, 30,000 divided by 500 units produced is giving you that $60 per unit. If you're releasing those units in year one, that's when you're going to see those costs hitting your income statement. You're going to have an extra $6,000 in your accounting system, which is going to make your net income lower by 6,000. All right, good. Who wants to do year two? Ty?
Yeah. Since the production is greater than the sales, the ending inventory is also greater than the beginning inventory, and the net income under absorption costing will be greater.
Okay, good. So in this case, I'm producing more than what I'm selling. So my net income is going to be higher under absorption costing, because you can see you have 100 units in your ending inventory. And the question is, how much higher? You have 100 units that you didn't sell. So how much fixed factory overhead is getting deferred here? How much fixed factory overhead is going to be tied to these 100 units? Actually, okay, so the fixed overhead tied to each one of these units is how much? Okay, so you're saying that when we got that $60, we took that 30,000 and we spread it out over 500 units produced, right? Take a look at what we're producing in year 2. So this is what I was saying. Your production usually is not the same. So the fixed overhead in these units is not 60 anymore. It's 50. I'm going to take that same 30,000, but now I'm spreading it out over 6,000 units produced. And so each one is absorbing $50 of that fixed factory overhead. So when I'm looking at those 100 units, I'm deferring $50 for each one of those 100 units, and my net income is going to be higher by $5,000. Okay, who wants to do year 3? Kenzie.
Year 3, it will be the same, the net income, because the amount produced and the sales are like the same.
Okay, good. I'm glad you looked at both, right? So I know if I'm following along with the textbook's little shortcut, they're saying what's your change in inventory? And I know I'm starting with 100, I'm ending with 100, so I know there is no change in inventory. So the net income should be exactly the same, except I need to look at production levels, right? So when I'm saying I produced 600 and I still had hundreds to start with and produced 600, and then I sold 600 and still have 100 left. Well, which 100 do I have left? Do I have this, or is it 100 from this? Right, so in this case here, like Kenzie said, it doesn't matter, because I would have still in this period taken the 30,000 and spread it out over 600. So I have $50 of fixed overhead here from this period. And then here I'm also spreading it out and I'm getting 50. So the cheat works here. Okay. Fun stuff, right? Fun? Who needs to do go when you have managerial accounting? And it's my birthday. We get to do what I want today. I like financial accounting. I mean managerial. Okay, so here's another question. I'm going to see if I can trick you here, right? So I love to throw in these questions that I think look a little different, right? So here, Regal Printing Inc. prints and binds encyclopedias. Who does encyclopedias anymore? But following the information, so here is your accounting information. Selling price. This looks just like the other problems, right? Direct material, direct labor, variable overhead, even easier than the other problems. I've done the fixed overhead per unit for you. I've taken that total fixed, divided it by units produced, and each one is absorbing $25. Here's your fixed selling. Here's your fixed variable. Again, easy. I've already taken that per unit number and multiplied it by units sold. Now I'm also telling you, you made 80,000 units and you sold 75. So if I'm looking at this question here, I know that if I'm going to be preparing my absorption costing income statement, my net income is going to be higher than my variable costing, because I'm going to have 5,000 units that weren't sold, and those 5,000 units are going to have $25 of fixed factory overhead tied to them. Okay, so that could be a possible question that I could ask you, but that's not what I'm asking you here. So first of all, I'm saying under absorption costing, what is the net operating income? So again, you should say absorption costing, traditional format. And so I need to know what is the value of my inventory. Materials, labor, variable, and fixed. I know that it is $97. And then I can go ahead and do my income statement. Selling price is 120, and I'm selling 75,000 units. So I'm looking at sales. Here's your cost of goods sold, matching the cost of making the units that you also just sold. And then you are going to get your gross margin or gross profit. And then here are your operating expenses. And you have your net income. Okay, so practicing these income statements, it will just get you to move faster, right? But then, so you've got the net income, and now the question I'm asking you is, under variable costing, what is the ending finished goods inventory balance? So let me go here. Under variable costing, what's the ending inventory balance? Anybody? Inventory is valued at the cost of making it under variable costing. Justin,
Would it just be 60,000?
so how are you getting 60?
Just taking the variable overhead times the units that are remaining in inventory, the ending inventory?
All right, so the answer is 360. So what you're looking at here, produced 80, sold 75, so you have those 5,000 units. Your ending inventory under variable costing includes 3 product costs, not 1. Right, so this is a little bit different because all of those other questions were asking you, what's the difference in net income? And the only difference is because of the fixed factory overhead. But here I'm asking you, how do you value your inventory? So now I'm telling you that these 5,000 units would be valued at $72 a piece. I could ask you, what's the value of these 5,000 units under absorption costing? And it would be 5,000 times the 97. Right, so watch the question that is being asked, because you're going to do question after question about what's the net income under variable, right? Absorption, what's the net income under variable, and then prove it. So just watch, don't make up your own question. If they ask any inventory, then you're answering a different question here. Okay, so this is your exit question today. So here's another problem. And what we're looking at here is units produced 100,000, units sold 80. So net income is going to be higher under which income statement? Absorption. Okay. All right, selling price, direct material, direct labor, variable overhead. Here's your fixed factory overhead in total. And then the variable cost per unit is 1, and the fixed selling and administrative costs are 125. The first question I'm asking you, even if I didn't ask it, this is what you would have to do first. What is it costing you to make 1 unit of product under absorption costing? And what about variable costing? Variable is easy. Direct material, direct labor, and variable overhead. Fixed, the absorption costing needs to add this fixed factory overhead. Am I dividing it by 100,000 or 80,000 to get that per unit number? Netra.
100,000.
Yeah, units produced. What is it costing me to produce or make? So under your variable costing system, $9 per unit. We're adding another 5 in your accounting system. Okay, so under absorption costing, what is the net operating income? Under variable costing, what is the operating income? And then show the difference in operating income and how it is, or what's causing the difference, basically. So what I'm asking you to do is then reconcile the two, right? Or you can do this first and then figure out what the difference will be and then do the income statement, right? But the idea here is, if you're going to reconcile, and actually let me show you. So here's what you're going to do. You're going to calculate net income under absorption costing. You're gonna calculate net income under variable and then get the difference between the two. And then what I'm gonna do is have you do the shortcut the way they tell you in the chapter. Look at the change in your inventory, multiply it by the fixed factory overhead, and reconcile means to make sure that those two numbers match. All right, so this is your exit question. There is this template up under the chapter 4 folder under the topic focus 3. And so this is what you're going to submit to me today by the end of class.
Professor, I can't find it. What folder?
Go under resources, under chapter 4, and then under topic focus 3. Right, and as usual, you don't have to use the template if you don't want to. I just have it set up so that you have the right format, right? Your traditional and then your cost of your contribution format.
What numbers are we using?
From the problem. Yeah, if you don't have your slides up, you might take your phone out to take a picture of this. Or just write down, under variable costing, inventory is valued at 9. And under absorption costing, we're adding another $5 in fixed overhead. Yeah.
The variable and administrative selling cost, would that be included in the variable manufacturing overhead?
No, because overhead is a product cost and that's a period cost.
So would the only variable production cost be the direct material, direct labor, and the variable overhead?
Yes. Yep, period costs are always period cost. It's just fixed factory overhead that is also now a period cost. Thank you. Okay, so this is the end of the class, so you want to submit to me what you have. So, don't panic. I know I didn't give you a whole lot of time to do this, right? So this is class participation, not graded for accuracy. I'm looking to see where you are. That's part of what I'm trying to see, you know, in terms of where you are. I only grade you based on everybody else that have the same amount of time. Okay, so submit what you have, right? What you don't want to do is pass it in late because then you lose points. So submit what you have, and then I will see you Friday.
Thank you.
Okay, everybody's good? Make sure you submit. More
Thank you.
submit on
Thank you.
time. I'll see you later. See you Friday.
Hi, Professor.
Bye.
I have a question.
Yeah.
For question before the exit question, like in the slide 30. Yeah, for the practice T 3.3.
See you later. This one?
Yeah. Like when you count the changes in net income, like why do you use 72?
This is not the change in net income. This question, that's why I pulled this question out. The question asked you, what's the value of your ending inventory under variable costing? So under variable costing, you're valuing your inventory at $72.
Okay.
Right,
So,
so this question was asked a little differently. So all the other questions I said, what's the difference in net income? So here I'm asking you, what's the value of your ending inventory?
okay. So we use the total cost under variable cost.
Right, because under variable costing, these 5,000 units are only valued with your 3 variable production costs.
Okay, got it. Thank you.
Yep.
Professor, I just have a quick thing to ask.
Okay.
Yeah, so I mean, under the assignment for our case 1, like even though we submitted both the peer assessment, it's the status, it shows as incomplete. Do you know why it is showing as incomplete?
If you've done it all, it should be fine. I don't know if maybe you didn't give a grade or something, but if you did them, you'll be fine.
Also, even though we submitted, even though it shows incomplete, it will be fine. And if we submitted the peer assessment.
Yeah, I'm looking, yeah, yours is fine.
Okay, thank you so much.